Welcome to Money Hangout once again. Every week we try and pick an area of your interest, something which is top of your mind, help you understand mutual funds, and also try and answer your questions. This is brought to you by Birla Sun Life Mutual Fund and Value Research. Today we are going to talk about something which is not now, but it is always top of our mind. How to go about buying our house, or maybe investing to buy our house. Buying a, how to invest to buy a house. And this is where, it's a big decision. Indian houses are expensive. They're expensive relative to anywhere else in the world. Uh, on a relative scale, for all segments of the society, the kind of houses that we need, uh, it should be considered as a relatively more expensive thing in India than anywhere else in the world. That apart, it comes with a great deal of anxiety. The house that you buy, till recently it was not regulated. The Real Estate Regulation Act is a relatively new thing, so consumer interest being protected there. That apart, so we have there is, it's not only going by the scale of it, going by the scale of this buying decision. It is perhaps the biggest financial decision that we take in our life. And so far it was unregulated, so it was quite vulnerable to a decision which might be right. You would have done all the due diligence, despite that things not going wrong, not going right, not getting the house in time. A delay of 5 years sometimes in and around Delhi is considered to be quite normal. So in that context, all your planning goes haywire. So how to go about buying a house? And should you ever invest in a house? Of course, by now most of our listeners, all the people, many people coming to our website will have an understanding that why never to invest in a house. And I think a lot of people are just reconciling to the whole idea. But why not? So first and foremost, why not to invest in a house? You should buy a house. You should buy a house in which you plan to live in. You should start staying there. That's the only house we should, and in fact, generally speaking, I always say that never borrow to invest. And generally speaking, one should also not be borrowing for anything unless it is an emergency. And the only borrowing which justifies for an individual is buying a house, because home loans are relatively cheaper. You get the tax break as well. You start saving on the rent, and then it is a long-term debt. So even if you have to accumulate your save, even if you have more surplus on an ongoing basis, it is better to be investing regularly, because a home loan of this term, 10-year, 15-year, my understanding is that any investment in equity by way through SIP will be generating more return than the interest that you will incur on your home loan. So this is the only loan which, only long-term borrowing, only long-term loan which is justified for an individual. Why you should not, I would just like to summarize that why you should not never consider investing in a house. One is poor liquidity. Uh, you can't really buy and sell houses at will, and there are times when it becomes almost impossible to buy it, or impossible to sell. Not only that, the form in which you get the money. A lot of homes, your ability to sell home becomes constrained by the cash component which you will derive, or if the price has gone up but you may not be able to realize all the money. So poor liquidity and the form in which you get the money back may not be desirable. It becomes illegitimate. Big ticket size. We talk of SIP. You can do it with 500 rupee, you can do it with 5000 rupee. Here you can't think of anything till it is a reasonably large scale. So taking a big bet, a foreign investment, and that too in a leveraged way, if you're borrowing for it, it becomes quite questionable. Uh, Need to be sold at one go. You can't really, you don't have the diversified piece unless until you are a large real estate investor who has, 5-10 houses, so that you are able to diversify it. Then comes the manageability. Uh, Buying house is not enough. You have to keep it going. You have to make sure that it is in a form which is rentable, or it is sellable, or it's a good thing to actually show it to a customer who turns up for buying. So the upkeep of a house is, you have to see that whether you are geared, you have the resources to make that happen. Uh, Many a times we don't have a transparent open market. There is a lack of data when it comes to mutual funds, when it comes to any other investment, organized investment which is regulated. You know what's the basis of it? May be it may be good, it may be bad, but there is a basis to it. Here we don't know. We don't know what the last pricing was. Where what happened in the neighborhood, who bought what with what motivations, and why a transaction happened at a certain price. So I would say that these are these are quite complicated things. Then comes, how the community comes up, how the surrounding comes up, how that particular location comes up. There are a lot of ifs and buts. The places there, in Delhi, I have seen that whole surrounding, the whole city, the real estate transaction has been happening in areas in anticipation of the metro connectivity coming up, and sometime that wait could be 5 year, 10 year, and maybe it could just be fiction. So validating all those things becomes difficult. But generally speaking, house house prices do go up where the work areas evolve, develop, and new areas, superior connectivity. So these are all in the realms of uncertainty around future, and most investments do have it. So do have real estate, but the ticket size, lack of transparency, these are serious concerns. Then comes, how much should you stretch? Many a times, when it comes to buying a house, we try and think of distant future, when we will have our grandchildren, and how the house should be geared to. And of course, one should be little liberal, or little uh, not so conservative in doing the estimation. But still, I think the kind of houses that we are going to live in, the community living that has been enabled by this high-rise developments, I think it is not a bad idea to be, maybe changing your house twice in a lifetime, depending on your needs or changing needs. House may not qualify as what we have seen in the past generation, that a house is to be had and had forever. Things might change, your needs might change, uh, the social, or your ability to maintain the size, the scale, everything can change. Also the maintainability of it. If you are actually a proportionate owner of the land, it's different to have a bungalow where you bought a land, you build a house. When you buy a flat, things do go out of fashion. Things get phased out, or things are not as they require maintenance, which may not, or the upkeep, which may not be keeping pace with your requirements. So things might be, it might have a value, but you would like to live in a newer, smarter, well-designed, superior, with modern materials, which might change over time. So things might change, and so can your thinking. And so maybe you should think long term think about the long term and the long term viability, or need of your house. But maybe too long term in the distant future may not be required. Make sure that you're not stretching, because many a times we go and buy a house with that mindset that a house is forever, and we stretch ourselves beyond a point of being constrained in our day-to-day living. That is undesirable. Make sure that in the worst of situation, you are not spending more than a third of your income, if and ensure, of course, it is a third is not a thumb rule, because it can well be a function of the scale of your earning. But generally speaking, if you are able to spend all your money, if you are not able to save substantially, then make sure that not no more than a third of your income goes towards that, towards paying your EMI. That will make sure that you have a reasonable balance of your other spending requirement that you might have. And one critical thing which is far more important in North India, but could be a problem across the country, that now, of course, we have the Real Estate Regulation Act. This regulation has come about, and we have to see that how it gets implemented, how it succeeds in protecting the buyer's interest. But still, there is a problem here. This is an area where what you hear is not what you get. What you are being promised is not that is not when you get. A 5-year delay in and around Delhi is quite normal. And similar situation could be there in other parts of the country, though I'm not very aware of it. But other parts of the country, I'm told that they're much better. But this is absolutely not negotiable. Real Estate Regulation Act has provided for, has made some provision to penalize the builders, the realtors who actually sell these projects. But eventually, is it worth the heartburn? So make sure that whenever you decide, you are deciding based on the state of the project, the likelihood of getting it, and taking a measured bet, not a long. You can't really see a land and buy into a plan. That is something which will throw surprises. And of course, the due diligence that you can exercise now. The Real Estate Regulation Act definitely makes it much easier for investors or buyers to exercise diligence. You can see the documents, make sure that it is all, and you can also ensure that what is the carpet area of the house that you're buying. So it definitely brings about a great degree of transparency, ability to validate those things, but making sure that you are likely to buy a house which you will definitely get it in a defined time period which you have planned for is very important, and you can only do the subjective evaluation. Now the critical question is, this is all about how to go about the framework that you should follow when considering buying a house. But then comes how to go about making investment. If you are planning to buy a house anytime 2-3 years from now, 5 years from now, 7 years from now, how you should go about investing. My advice will be that go aggressive with your investment for this. Be regular with your investment. Do your SIP. Never invest lump sum. And make sure that you are investing in a reasonably. So choose your multi-cap fund. And why I'm saying so, why I'm not asking you to be very conservative here, because this is a negotiable goal. And this negotiable goal, meaning if you plan to buy your house in 3 to 5 years time frame, there is a possibility. It doesn't hurt to buy your house just after 2.5 years if you get lucky with your investments. It also doesn't hurt to postpone your buying decision if your investments are still accumulating and it has not done as well as expected. And if it takes 5 to 6 years, it doesn't matter. So there is a great deal of negotiability about your negotiability of the time frame. So having this time frame, so get aggressive, and if you get lucky, go ahead with that. Two thumb rules to follow, which I generally think is good to err on the side of caution or be a little conservative. Make sure that you are not going to pay more than a third of your income by way of EMI, and make sure that you are putting 25%, 20 to 25% as the down payment. That will reduce your EMI. At the same time, you will have reasonable equity. It will not be a speculative investment. And by what I was suggesting earlier, that if you will be able to save your rental outflow in 1 year's time frame after taking this decision, that will be additional saving. So the EMI will be a problem only for the time period when you are actually living in the rented house while you have started paying for the house that you have bought. So that's all there to it. Get aggressive for your home. Don't think in terms of investing in a house. Buy a house which you plan to live in. Buy a house which you are likely to live. You will start living in next 1 year's time, after you have initiated the whole plan or you have triggered the whole purchase decision. And make sure, and this is make sure that you are not borrowing your borrowing is not of a scale which will take more than a third. And make sure that you have 20-25% of your equity, of your contribution down payment going to buy this house. Best of luck, and I'll take your questions around this area.
Thank you, Dhiren. Our first question comes from Mr. Srivastav. He asks if he should repay his home loan from his bonus or invest it. So what should he do with his bonus?
I would say that this is the only loan which one should carry on, because if you are not actually constrained by your EMI, then it's always good to carry on with your home loan, because home loan will not generate the, there is a cost to your home loan, but your return on the SIP for over a 15-year period, for sake of discipline, will turn out to be, more rewarding. But at the same time, this is a bonus. This is not a regular investment. Maybe carry on with your normal SIP out of your regular savings. Maybe if you are just trying to time it, it's worth considering it. But home loan and SIPs can go on. I don't think one should be derailing. Generally speaking, one should not, take out one's accumulation by way of a structured regular investment plan to prepay one's home loan. But it's entirely up to him. And going by the scale of the market, one might be a little tempted to. But even investing it with a 10 to 15-year time frame, I think he will end up being a winner with his investments.
On a related note, Dhiren, Ashwin says that in his opinion, home loans at about 8.6 to 8.7% that's prevalent these days are free money, and hence he's maximizing his loan ticket size so that he can invest his own money in mutual funds. Is that reasonable? And how does this fit with your opinion and your advice on contributing at least 20% of one's own money, Dhiren?
No, I would say that the whole idea is to make sure that you are not contributing heavily out of your income. If 60% of your income goes towards paying the EMI, it is not a wise thing, because we are all thinking people. Uh, if there is any uncertainty about your job, your mental framework changes. We are still psychologically extremely uncomfortable with the possibility of losing our house just because we lost our job. So these are real possibility. So one should, when buying a house, it is not an investment. Of course, 8.6 or 8.7 is not very expensive borrowing, but by any yardstick, it is not free money. And it amounts to, and in future, this is the kind of return which will become extremely difficult for investors to earn with great predictability. I think that equity will be able to generate a return which will be much more than this, maybe 1.5 times and or twice as much. But it will come with great deal of uncertainty. It will in few in like you will get 20% return in 1 year, and it will go down by 10% in another year, and then another year it will be up 30%. So this kind of uncertainty of you don't get return from equity with that kind of certainty, and you don't get it in a nice straight line up. So it is always good to be little conservative with your borrowings. So make sure, I think this particular rule that you are not your EMI is not going beyond a third of your income, that will make sure that if everything is controlled. I agree with him largely with the broad principle that one should borrow as much as possible, as the investment returns could be higher as compared to the home loan costs that you will incur over a period of time.
Moving on, Dr. Chadha asks if it is time to sell equity and buy a house considering the Nifty has breached 9400 level.
I don't think you should be guided by the level of the Nifty, but I think you should be guided primarily by the, if you are investing to buy a house, and if you have the down payment, or if you want to, if you want to buy a sizable, if you are able to buy the house without the need to borrow substantially, by all means go ahead and do it, because but if it is going to be moving this money just for the heck of it, because one investment has done well and you think that buying a house is going to be an investment, I would suggest that don't do that. If you're going to buy a house just as an investment, it is undesirable for the same reason that I listed initially. It is less liquid. You can't sell it when you want to. The market is not very transparent. Your we don't know, and the rental yields could be very low in terms of the kind of return that you derive from home after if it is an investment, the kind of return that you can derive by way of rent could be very low, particularly for residential property. So all the complexity that I explained earlier, for that reason I would say that don't move your money from equity to buying a house just because you think you think that the market is expensive and houses are cheap. Houses can still get cheaper, and it has all the attendant problem. If you want to buy, you plan to buy the house and you plan to live in that, by all means go ahead and do it tomorrow.
This next one comes from Mr. Chaudhary. He says that he wants to buy a house in Chandigarh from his retirement benefits, but the sellers are not accepting payment in white money. He says that they want all the money above the circle rate in cash. Now, how can he proceed?
He should not proceed. He should have patience, and he should wait for the buyer, and he should also be willing to compromise on a house where the seller is willing to sell it in an entire check deal. And because this is a legitimate activity, but this has been the way of life. This is how the business, or buying a house or a land is conducted in this country so far. Things are going to become increasingly difficult, and at the same time I find that particularly in cities, particularly in larger cities like Delhi or Bombay, or possibly in Chandigarh as well, there will be customers, there will be sellers, not in large number, and over a period of time, and the people who will be willing to take an all check will also be willing to settle for a slightly lower price for a transparent, clean transaction. So have patience and keep looking.
Next up, Chanchal says she is planning to buy a house after 4 to 5 years. She asks where she can invest her money for this duration to get a better return than FDs.
I would say that, as I said earlier, that buying a house is a negotiable decision. You can well buy it after 3 years, you can well buy it after 5 years. There isn't a date on which you must buy. And of course, you should, if you plan to buy it after 3-4 years, then you should be in complete preparedness with your money when you go on the lookout for a house. And so I would say that get aggressive, start your investments, and make sure that you have 20, 25, 30% of your house, the house that you want to buy, that part, 20-30% of that value of that house by way of down payment. Invest in 1 or 2 multi-cap fund. That should be good enough. And once you start looking out, you don't necessarily have to prepare for it, but I would say that once you seriously start looking for it, realize your money, because markets are volatile. And exactly, you don't need to do a SWP, you don't need to do a periodic withdrawal as you will do in case of your retirement, or accumulating for your retirement, or accumulating for your child's education. But the day you see that you have the down payment worth of your investment value, realize it, liquidate it, put it in a fixed income fund, and then start your lookout more aggressively.
Moving on, Debraj asks what percentage of his net worth should be deployed while buying a house. Any advice for him, Dhiren?
No, there isn't a thumb rule, and I don't think one can advise him. But I would say that these are all moving targets. If you are 25-year-old, you will have no net worth. But if you are in a well-paying job, and if you are inclined towards savings, your net worth will accumulate substantially. I would say that around retirement, I would like to, and of course, the net worth is also a function of how the house prices have appreciated, and how smartly you have invested your money, and how it appreciates. So it is not worthwhile doing this estimation. And once you have, there are two things about a home. One is that it's a home, it's not an investment. It might have a financial worth, it might be realizable, but it may not be realizable in your lifetime, because you will just continue living in it. It might be a state for your inheritors, for your successors. So in that sense, you can think of if you have gotten lucky with your house, which has appreciated in value, you will leave a larger state for your successors. And that's the only way that's the only way you can think about it. Otherwise, you get up in the morning, derive the comfort of living in your own house. That's about it, and you don't pay rents. And you can get the house tastefully done without the worry of moving to new houses every year or so. So you have great deal of convenience, emotional comfort. All that is fine. But this you should not worry about this. Buy a house in which you plan to live in, and start investing as much as possible, and based on your goals and the time frame that we keep suggesting all the time, that long-term money should go get into equity. And if you are disciplined about it, you will have a large net worth. Which form it is, I would say that most people should not consider house in which they live in as a net worth. It is just a notional net worth.
Gagan says that if he doesn't buy a house now, he probably will never be able to buy one as the property costs keep increasing. So he wants to know, should he still do an SIP and buy a property from the proceeds on retirement?
It depends. I would say that, I don't quite agree that if he can't buy the house now, he may not be able to buy it ever in future. Things change, and things change quite dramatically. There is a possibility that real estate prices might come down, but this is a possibility which has not materialized. But there is something called a time correction in the real estate context, that a house value never comes down theoretically. But so a house which is worth 50 lakh rupees today, uh, that never comes down. There is never a correction like the stock market in the house price. But if 5 years from now, if you are going to get that house again for the same price as 50 lakh, it has actually come down in value by nearly 30-35%. Because if there is an opportunity cost of money, there is a risk-free return on money, which would have accumulated to that much amount. So if your investments are growing at a faster pace, and if house prices remain constant, and and also I think this is something which we have forgotten. In the 90s, people who bought houses in Delhi, they were able to sell the same house after 10 years. Houses bought in Gurgaon until in 1990 were sold at the same price in 2000 as well. So house prices remain constant, and I would say that going by what was the price in 1990, if it was sold at the same price in 2000, then those prices actually came down by nearly 75%, because then the prevailing interest rates was 12-13%. So Indira Vikas Patri used to double your money every 5 years. So going by that yardstick, I think those values actually came down substantially. So house prices do come down, though you may not see it. And if your other investments do better, you will be able to buy not only a better, bigger house, but maybe you might be left. You will be left with more money than the money that you have accumulated.
Next up, Harshit asks if he should wait for the Real Estate Regulation Act to become effective before purchasing a property.
Real Estate Regulation Act has become effective in 13 states. Some of the regulators have come into being, and I don't know, it will take 3 months for it to get operationalized. Most of the projects being sold right now are the older projects which were initiated before this, and the Real Estate Regulation Act has a provision of assimilating or becoming effective even for the project which has not been delivered to the customers, to the buyers. And after 3 months, even the older projects have to comply with that. But all state governments have to implement this Real Estate Regulation Act. So many state governments have done the tweaking in terms of how they should comply for the older projects. So it depends. Check out in your state where you plan to buy the house. Look at the real state of the real estate regulation there, and maybe some waiting might be useful, because I think there are there are things which will become clearer. There are initial issues which will gain greater clarity once the real estate regulator becomes operational, and at least access to information in the public domain through a regulator, I think is going to be one of the biggest turning point, because right now there is absolutely no basis. All we see is just hype and lies, uh, and what you get is not what you see or what you are being told. That thing will gain clarity. That thing will actually get resolved. You will exactly know what you are paying for, how much space you will get, and is it a legitimate activity. So it will act as a great filter, quality filter, and so it might be worthwhile waiting.
Dhiren, we'll extend today's session slightly longer to accommodate a few more
Sure,
questions.
sure.
Thanks. This next one comes from Saurabh. He asks if it is an intelligent decision to not buy a house and live on rent forever, and at what rental yield versus interest rates is buying a house more attractive?
It might be a logical decision if rental yields remain as low as they are right now. In all the key cities in India, the rental yield could be, as low as uh, less than 1% or 2% of the home values that we see today. So if this is the situation, it might make logical sense. But then everything doesn't really work on logic. As you get older, it also depends on the kind of comfort that you derive from moving around every 2 3 years. If you don't get lucky with a landlord who allows you to live there for long enough. Also, as you get older, you become a little more anxious about having the emotional comfort of being stationed at a place, a fixed address. It's also embedded in our culture that if you have succeeded in life, you should have a house. So maybe social acknowledgement and recognition can also be one of the factors which makes us think that owning a house is important, and understandably so. There could be a lot of conveniences that can be derived, but I would still say that if you have so have a house and make and I would say that it makes eminent sense for in going by looking at peeping into the future of the outlook for interest rate in coming years. I would say that a rental yield of 4 to 6% justifies buying a house.
This next one comes from Vijender Paul. He says he kept the proceeds of his urban land sale in a capital gains account on the advice of his CA, who is now advising him to buy real estate with it to avoid tax. But after reading your article, he is considering paying the tax and investing the proceeds in mutual funds. What should he do?
Yes, I think so, because if you are going to, that is based on the simple principle that we are so wedded to the whole idea of saving tax anyhow. That should not be the idea. And if you are going to buy a house which you don't need, that also is not a great idea. That apart, all the inconveniences of buying a house, maintaining it, or making sure that nobody if you buy a land, that will not be grabbed by somebody. If you want to, and that is another advantage of a financial investment, that you can do it at your convenience, and it happens with great ease. So I would say that if that's the idea, and over a period of time, I don't think going by the kind of upheavals which I see in real estate. Of course, it is all subject to very unique situation, because it's very difficult to really club all real estate in the same manner. But generally speaking, I would say that the world of real estate is going to be very different in future than it has been in the past. uh, Looking at it from the yardstick of the cash component and the check component, the circle rates, the way you buy it, the Real Estate Regulation Act, the way land will be allotted, the focus on low cost housing in India, the kind of mismatch that we saw in the marketplace, that everybody needs a house, but the houses that were built were not of the kind which people need. So the bad, poor delivery, the speculative market, there were investors who were just speculating it in real estate based on a 10% or 5% contribution. So it was a leveraged trade. So we saw all those excesses, and I think things are going to get fixed in a reasonably permanent way, because now we are seeing a complete paradigm change with the regulations, also with the general economic climate, with the demonetization, the way things will be trailed, the way circle rates, and the way real estate will be tracked down, or reduction, if not elimination, of black money in the whole process. So I would say that invest, keep it transparent. You will also have a peaceful night sleep.
We have the next couple of questions, Thiren, which are though not related to today's topic.
Mhm.
Venkat says his ESOPs are trading at all-time highs and are worth about 10 lakh rupees. Now he's afraid of a correction. So should he withdraw them slowly and move into equity mutual funds?
I have one thinking about ESOPs. Of course, if you know your company best, but one can also be very biased about one own's company. And ESOPs, generally speaking, if this is all your, one should be taking a financial, a prudent view on your ESOP. Uh, if you are optimistic about your company, then one should hold it. But generally speaking, there is the other side to it, that ESOPs will go down in value exactly around the time when you will also be very apprehensive about your job, or maybe you will lose your job. Think of that possibility. So that is why one should diversify. And so from that standpoint, it always makes sense to diversify, though there might be a opportunity loss, because if you are working in a great company and this company has a great potential, and you have decided to bet your career on this company, and you think that it will grow and it will become a, a large, so maybe a part of it you should diversify and de-risk yourself, if this is going to be, if this is the only financial, or if this is a sizable part of your net worth today, financial net worth today.
We'll take one last question for today's session, Dhiren. Mrs. Chima says, although she has invested in mutual funds, she is very worried about their safety. She's a new investor, Dhiren, and she wants to know, are these investments safe?
One should be worried because markets have gone up very dramatically. I don't know which investment she has made, but if you are a first time investor and if you have followed the rule, and if you have that time frame in your in your mind, and the rules are pretty straightforward. First time investor should only invest in tax saving funds where your money gets locked in for 3 years, or in a balanced fund. You should never invest lump sum. And if you are not doing, and you should always invest with at least 3 to 5 years time frame in mind. If these three things are not in place, take your money out if you are sitting on profit and get started all over again. Violating these rules for a new time investor could be could actually trigger a lifetime opportunity loss, because once you see a 20% decline, you will be out of the market at a very inopportune time, and this will become a classic case of buying high, selling low, and never to come back in the market again. So being methodical about this, your long-term investment, follow these three rules. Only long-term money to be invested in equities. Always invest through SIPs. First-time investors should only invest in balanced fund or tax-saving funds based on their needs.
Thank you, Dhiren. Any closing remarks for our viewers today?
Yes, one is that the kind of impression that we have about real estate, unclutter your mind from that. Future could be very different from the past. Don't consider real estate as an investment. Consider it as a home, and it's buying a convenience. Of course, it goes up in value over time, but you can't realize it. And also consider all the inconveniences. So look at things very objectively, look at it logically, and don't get carried by the whole, because it's also an emotional decision, the location, the house, the quality, the design, and where we spend a good part of our leisure and our growing up years. But still it's an economic decision. Be very measured about it. Don't get carried away when buying a house. Be logical about it.
Thank you, Dhiren.
Thank you.
And thanks everyone for joining us. We look forward to your presence next week as well.